Again, and we are live on LinkedIn. So, it's going to be an exciting episode as it is always. The world is always changing, and this week is no different than most. So let's get started here. Let's get rolling. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. And once again, I'm joined with my good friend Doug Hagerin. Hey, Doug.
Hey, good morning, Kirk. Happy Friday to you, and happy Friday, everybody out there who's searching for a new job. Because isn't that what LinkedIn was built to be, right? A resume platform. It's morphed into something a little different, but in the end, it's still supposed to be a job search site. So hopefully that's working for somebody out there that's looking for their great next opportunity.
Yes, well, we're also on YouTube. I don't want to leave out YouTube because people go there as well, and frankly, LinkedIn does a poor job of promoting this show. So I'm not going to give them all the credit. Let's spread the wealth. So let's kind of dive right in. This has been an interesting week. We recorded our last Wednesday episode on Monday, which was after the Silicon Valley Bank and the Citizens Bank, not Citizens Bank. Now it's Friday. What is it, Doug? It's
First Republic, was that one of
no,
them?
not First Republic. It's the other one. Was it Citizens? Not Citizens.
Out of New York. No, give me a second. I'll think of it. I'll remember it. Yeah.
Brain fart Friday. Anyway, it was one of those banks that probably shouldn't have been around. But so it's funny because I was talking to a friend of mine last night about the second bank, which I'll find in the news.
Signature
But
Bank.
Signature, that's what it was. Jesus, this is a crazy day.
I'm here for you, Kirk. Not as fast as normal. Sorry about that.
We're both a little slow this Friday. So Signature
I mean,
Bank.
Signature. Who cares about Signature? I mean, whatever. It's just another bank now.
Well, so what was interesting is I was talking to my friend and about this, and I didn't follow the Signature Bank thing because I just saw it. I'm like, it's another bank, whatever. But coincidentally, what I've been hearing is Signature Bank wasn't even in need of going under. The FDIC basically just stepped in and took it over, and I guess it was because they were doing a lot of crypto stuff, and they didn't like it, so it was kind of, some people were claiming it was an excuse to take it over. I don't know, fog of war. It's none of my business. I don't use the bank, and New York's kind of a crazy place that I wouldn't do business with if I could help it, in California either. And lo and behold, those are the two states that had problems. But Silicon Valley Bank is interesting, and we talked about it on Monday, but I think it deserves a little more conversation. And what I want to talk about a little bit is the concept, right? Because you can look at the news and you can say this is good, this is bad, and liberals, Republicans, whatever you want to draw the line at. But I want to talk about it conceptually, okay? So here's a bank that, let's just say they weren't doing their risk management properly. They're more focused on.
No way, Kirk. Sorry.
Ooh. I know. Sorry, you couldn't contain yourself, Doug. I know it's hard. It's hard. Keep it in. Keep it in. They were so focused on woke capitalism and appealing to their party, so to speak, or their audience, which can't blame them, right? If your audience are liberals, you could appeal to liberals. If it's conservatives, you appeal to conservatives. So I don't knock them for that. But I would say if you're going to do that, you should probably focus just a little bit on risk management when you hold people's money. So, that being said, I think that there's a large part of this which people probably don't understand because banks are confusing, right? They shouldn't be, but they are. So when banks are created, they're effectively insolvent because they're leveraging up their money. And if you pull out your money, then there's no more bank, right? It's like you own a house, right? You put down 20%, you own a house, you put down 20,000, you own a house for 100,000, right? Well, as long as the house doesn't decline 20%, you're fine, right? You still have equity and there's no problem. Once it's more than 20, well, now you're going to owe the bank money if you ever sell that house. That's a problem, right? But with banks, it's less, right? And they didn't have any reserve deposits, so it could be whatever you want it to be. But that wasn't the problem. The problem was they bought bonds that were a lot further out on the spectrum, which means that if you pulled your money out, you needed to sell the bonds at a loss, which means all of that equity disappeared. So just like owning a house, if you sell it when there's no more equity, you owe the money back, right? And you're basically, I don't want to call it bankrupt because you might have other assets, but effectively you have no other assets, you're bankrupt. Like you owe money that you don't have, and so you have to go into bankruptcy. That's basically what Silicon Valley Bank was. Right? They had no other assets, they had to go to bankruptcy. Now the interesting thing is this is a technology company-based bank. It really supported the technology community. And I was talking to another friend last night who's also big into venture capital. And, I appreciated his thought process. He's like, I really want to support the bank, even though, I think they messed up. I really want to support them because we really need a funding source for technology companies if they really want to grow and get capital, which I can appreciate. We have one of the best centers in the world, or we have a few centers. There's one in Dallas as well, and in Boston. We have a handful of hubs that are really good with technology. And most of the new emerging technology in the world comes from these places. Even though you may or may not agree with their politics, that's where a lot of the new technology comes out of. So we need to be able to support this because that's where the advancement and the innovation in our country comes from, which is what drives a lot of our country's capitalist structure. So you have to kind of circle it back. You can't just look at it in one lens, say they're good or bad, but it's all interrelated. So if you look at that bank, I'd say, all right, they screwed up and they probably shouldn't be around anymore. Let's be honest. But what happened was the FDIC basically stepped in and said, all right, we're going to guarantee all the depositors. Well, what effectively happened there? Well, for those of you who weren't paying attention, here's what happened. Silicon Valley Bank is now the safest bank in America. The government is basically guaranteeing through the FDIC all depositors in the SVB, in the Silicon Valley Bank. It is the safest bank in America. So you know what's going to happen? All these other places, all these other money are going to come flooding into this place. All of the big banks are going to put money there because it's basically guaranteed by the government. So, I have, $20 million. I'm only guaranteed for 250,000. Well, I'll put the rest in this bank because it's basically guaranteed for all of it. Right. And this is effectively what's kind of happening with First Republic, or so I hear, is that a lot of these other banks are basically pouring capital in there because for different reasons, which I think is actually a brilliant solution by the Fed, is they don't have to jump in. They can have the banks support each other. But it gets a little complex, and I don't want to go down this rabbit hole because I think it's a little in the weeds for our talk. But I do want to say that we need to understand the banking system and how it works. It is a highly leveraged system. It is dependent upon the positive psychology of the depositors. If people don't trust it, there's a run on the bank. There's a run on the bank, there's no more bank. We need to understand, and I'm not saying don't take your money out. I'm the first person to take your money out. So don't hear me there. If you hear there's a bank run on a bank,
you're the first person to take their money out?
Well, yes, actually, it's their money until I get it back, right?
Okay, there you are.
Which I actually want to put that in here, is because when you make a deposit, technically it's their money, but you can take it out anytime you want.
That's right.
They can do whatever they want with it. So you need to understand there's some nuances there. Like when a bank goes bankrupt, like there's certain levels of hierarchy, but I don't want to get into that either at this moment. So the point I'm making is that when you get to this level, if there is a potential run on the bank, you should take your money out. If you can't, at the bare minimum, take out so you have less than 250,000 in any single bank for yourself. If you have more than that, your capital is 100% at risk of disappearing. Just like Silicon Valley Bank. If the FDIC would have taken them over, and if the government didn't quote unquote guarantee it, which you could draw your conclusions, liberal government, liberal bank, they're going to bail them out, just like they did in 2008 when they bailed out the auto workers. I'm not passing judgment. I'm just saying you can draw the lines, right? The Republicans do it too. They bail out their own. But that happened. But you can't rely on that happening, because basically what happened with Silicon Valley Bank is the government created a situation where they're creating more moral hazard risk. And if you don't understand what moral hazard is, I wrote a great article on this back in 2008, which talked about moral hazard. Moral hazard is this. Let's say there's two companies, right? Company A and Company B. Let's say they're both banks because we're talking about banks, right? There's Bank A and Bank B. Bank A, let's say they're exactly the same. And then all of a sudden, one day, the Bank A screws up and the government comes in and bails them out. Well, the Bank B sees them get bailed out, so they say, well, we can take more risks because we're going to get bailed out. They just took risks and they didn't get penalized for it. They still have all their money. They didn't go into bankruptcy. The president made like $10 million last year and he got to keep it all. Why wouldn't I just do that? So they say, well, I'm going to take more risk because now I got to compete with Bank A because they're making more money. So now I need to make more money. So I take more risk. And that way, well, if I get, if something happens, I get bailed out. If I win, if things go up, I win. If things go down, I don't lose. How, it's a great situation. So they take more risk. So next time, well, Bank B fails because they screwed up, and Bank A is like, well, the government stepped in. Now I can take even more risk. So this moral hazard risk is this ratcheting up of risk taking behavior, which is allowed only because people are not allowed to fail. And because capitalism is all about people failing and taking risk and managing that risk, that's what makes capitalism great, and that's what makes this country great. Is we have a society based on the ability to take risk. People don't talk about this. They talk about capitalism as those dirty capitalists are making money off poor people or whatever. You got people on both sides and people who are greedy. But what capitalism is effectively about, and if you look at other countries, they don't necessarily have this. And I'm not talking about China. I'm talking about Europe, talking about South America, Asia, Middle East, whatever. All places around the globe. We have one of the best places in the world for risk-taking ability. What that means is if you go to some countries, I'll give you an example. I think it was a buddy of mine was stayed in Prague for a while. Is if you had a business there, if you borrowed money there and you went bankrupt, you still owed that money. Not only that, if you and I could be wrong on this because this was like 20 years ago. I think things have changed since then. But if you borrowed money and you couldn't pay it back, they would put you in prison until you paid that money back. Now I don't know about you, Doug, but there's not a lot of things I'm doing from prison that are going to earn me money to pay off that loan plus interest. What that means is your
Debtor's prison.
relatives.
We have protections here against debtor's prison that go all the way back to the founding fathers, and that is
Right.
absolutely one of the basic principles of our freedoms and economy.
Correct. So we are built on an economy of risk taking. It's structured. We have bankruptcy. We have chapter 7, chapter 7, chapter 11, chapter 4. There's like three different chapters there.
Chapter 13.
Chapter 13. There's a whole bunch of them. But the point is we have law created to allow businesses to fail. You put in $100,000, you borrow $100,000 and it fails. Okay, so the bank loses their money, and you had a failure, and you probably have to pay some back or whatever. But the point is the system is structured to allow that. And the culture is structured to reinforce the fact that you want to do this. Look at all these whiz kids in Silicon Valley who were billionaires overnight because they came up with some cool idea that was funded by wealthy people that were saying, hey, I want to make 10x my money. So we reinforce the behavior of you should take risk. You should absolutely take risk. You should fail. We want you to take a risk and fail because it's the only way you find success. They talk about Thomas Edison. He failed 1,000 times, but he succeeded once, and that's why we have the light bulb, right? Like you talk about all these different things that they only happen because failure was allowed. In other countries, it's not enforced. It's not reinforced by culture. People look at society. If you start a business and fail, some cultures will look at you as a pariah. You failed. You're a failure. I mean, in Japanese culture, like failure is like it could be one of the worst things in the world, right? Like or I should say shame and other things. But the point is like some cultures reinforce this behavior and some cultures disincentivize it. We incentivize this behavior. So I'm not against failure. I think this stuff is normal. I think it's great. I think if you make mistakes, you should learn from it. But when the government comes in and rewards failure by not being able to take a loss and just bailing everybody out, all it does is it reinforces worse behavior. Now, if you're running a company, I 100% agree that you should take as much risk as you can and you shouldn't be bailed out because you took a risk, you failed. Banks are an integral part of our economy. So if a bank fails, that's okay. You knew the risks. You knew there was FDIC insurance of $250,000. You took the risk. That's on you. But if a bank fails and causes systemic bank failures, well, now the government has to step in because the economy is going to break and it will be irretrievable, right? So the banks need to be more highly regulated than they are, and have all these regulations, and They've obviously done a poor job. I mean, Barney Frank came up with regulation, and what happened? He was on the board of Signature Bank. You know, it's like you couldn't. This joke writes itself, right? And so people
The
need
name
to
of that bank
understand.
sounds familiar, Kirk.
Yeah, Barney Frank's from my state, so I didn't vote for him, but
Well,
I,
no, what I'm saying is you just said he was on the board of Signature Bank. I said the name of that bank sounds familiar, doesn't it? Because
so
that's what we're dealing with right now is Signature.
well, I want to kind of wrap it up because I want to give Doug a chance here. But I wanted to kind of like talk about the concept here because I think people get caught in the weeds and they hear stories and there's a lot of hyperbole and there's a lot of inaccuracies as the news typically does. But I think people need to understand at a core concept what is important in our economy, in the banking system, is banks should not be taking risk. And the, a whole bunch of regulations are created so they didn't take risks, yet they do anyway because some of them are poorly run. They're not all poorly run, but some of them are. And so what we need to do is really look at new regulations for the banks in a different way. I've had two ways. One I came up with, and actually a friend of mine came up with one. He sent it to me this morning, which I thought was brilliant. So one is you require them to have a certain spread. So they borrow or they give you 1% and they lend it out at 3.5, let's say. So now you got a 2.5% spread. That's how they make their money. They can't do anything else. They have to maintain that, and if they do it right, that should be pretty sound, and the bank should be able to do this. My solution is a little bit less tenable, but is obviously it will incentivize banks in the right behavior, which is all financial institutions, banks or other or investment banks or brokers, investment advisors are different. They're already fiduciaries, but everybody else should be set up as a partnership, which means in a corporation, if I run a corporation and the corporation fails, then I can take my $10 million bonus and leave and I'm not harmed. In a partnership, I am personally liable for all those losses. So all of the investment banks prior to the 2000s, most of them were partnerships. So if they screwed up and took risks and they failed, you know, like a Lehman or a Bear Stearns, they failed, all the partners are on the hook. So if you owed $1 billion, all the partners together were on the hook for $1 billion of their personal assets. So what happens? You are on the hook. Are you going to make a lot of mistakes? I wouldn't make any mistakes if I was on the hook. I would be as clean as you can get. I would take zero risk if I could because I'm on the hook. So unless you're tying the risk to the people, they're going to be incentivized to take as much risk as they can. And this solution will never come because they're not solving the problem. They're just creating more regulations, which doesn't solve the problem. It just hides it under a batch of regulations. If you want to change something, you change human behavior. That is how you make changes in policy, changing human behavior. So anyway, I don't want to keep going on this rant. I want to give Doug a chance to talk. We got a lot to talk about today. What are your thoughts there, Doug?
Well, you know, you shouldn't there. What you're talking about, Kirk, is you're talking about where. Well, first of all, let's go back to the business owners and taking the risk. When you say that you believe that a business owner should be able to take all the risk they want, but they should also be able to fail for that risk, right, and be left to fail. But there is still in our system a cushion for that, and that's called the bankruptcy system. Our bankruptcy system allows people who have taken these risks, taken this credit, and gotten into a situation of inability to repay to, without going to prison, be able to either restructure that debt or completely expunge that debt. And there's a pain that comes from that, but it allows us to reset. And you talk about being rewarded to fail. This is not a political statement, but of course, we live in a society where you can fail and become Donald Trump. Okay. I mean, how many times has he failed on many, many different types of investment opportunities, and he's revered for it. Okay. And you're right. In other cultures, the pressure that they're under to never fail at a single thing keeps them through their system, through their family and peer pressure, from being able to create opportunities that overcome what is effectively multi-generational class systems, right? You're stuck where you are because it is discouraged to do anything that rocks the boat. We are a rock the boat society, which is why it is very entertaining to listen to the way our society fights and and acts. And again, could we work on communications? Absolutely. But here's the thing. We have a system that allows that. But the problem is there is a time and place for regulation. Okay. Let's talk about a couple of the areas where this makes sense. And it mainly comes down to the common good. It comes down to making sure people are explained to what they're getting into and being protected as a mass collection. So here's a great example. I talked about this in our last conversation, the FAA. It is probably in, and I know there was some deregulation that happened in the early 80s, but for the most part, there is still a tremendous amount of regulation around the airline industry. And this is, I think most people would agree, this is a good thing. Now, I'm a private pilot. I listen to private pilots all the time who can't stand the FAA because the FAA's got very rigid medical requirements, and past a certain age, it becomes harder to keep your pilot license. Yes, but again, a plane falling out of the sky because of a heart attack is effectively a non-explosive bomb. Okay, so other than fuel. So this is a good thing for people on the ground. The FAA does not care about the pilot. Okay. You can do whatever you want with it. They care about your impact to other people. So these regulations are there to protect the people on the ground. These regulations are there to protect the people in the back of the plane. And because of these regulations, look, we don't have plane crashes. I mean, statistically speaking, the last major plane crash that we had of an American domestic plane that had casualties, it's been a long, long time. We've had a couple. I had a plane the other day that I heard about. My family was on. Their engine went down in the flight. They turned around, went back, got on a different plane. Okay. We have created an incredibly safe means of flight thanks to regulation. Let's talk about a second area, reverse mortgages. I know they have a bad connotation out there. Not a lot has to do with, first of all, it doesn't do anybody any good with 2 a.m. if you get somebody who is an aging actor selling everybody who shouldn't be up at 2 a.m. watching infomercials on why you're so desperate and suffering in life that you should use your house as the fallback ATM. Okay. But there's also things that went along with the mortgage industry that also caused that. And one of the problems with the reverse mortgage industry is, of course, is that when people were able to take that money out of their house, it used to be to get to a point in which the person that could take the money out of the house that might have achieved the age, if they passed away, their spouse lost the house. I don't know about you, Kirk. That's a problem, right? And it became a really, really apparent problem after the Great Recession of 2008. So what would happen is someone would become 62 years old, qualify for reverse mortgage, take the money out. Their spouse might have been 59, didn't qualify. The person that qualified eventually dies. Their spouse is left homeless. So they created new regulation. Now the new regulation says that if you do take a reverse mortgage on the house, you're never going to have to pay this back unless you move or pass away. The next generation can take care of it. But if your spouse was underage, they can stay in the house as long as they're living. Okay. Regulation for the common good. Banking, getting back to that topic. In 1933, okay, I don't know about you. Have we been through a banking crisis before that might have been a little bit problematic for the entire economic system, Kirk? I don't know. Maybe back, yeah, maybe we could learn from something. In 1933, after what was effectively this little event that they call the Great Depression, the crash of 1929 and beyond, they passed the Banking Act of 1933, otherwise known as the Glass-Steagall Act. What did this do? Well, part of the problem that was happening going back into the Great Depression is a lot of issues. Number one, someone who worked for a bank, an owner of a bank, could effectively borrow personally from that bank. You're not allowed to do that from your own businesses now within reason. Okay. What's another thing that they could do before 1933? They could basically invest in whatever they wanted with the money with no concerns about risk. And then what's another thing that they could do? They effectively could pay interest on checking accounts and any money there. And as you know, Kirk, how do you pay interest? How does a bank pay interest? They got to make interest to pay interest. So we passed a law in 1933, came into place right within days of Franklin Roosevelt coming to office. Okay. And what did it do? It separated commercial and investment banking. Okay. It basically said commercial banks could basically do no more than about 10% of their business could be invested in risky types of equity-based investments. In other words, keep that money from being subject to market, to stock market volatility. I don't know, makes sense, because that money is backing up the money that people have put with you that they expect to be able to get back out. Now, what is another thing that did? It took away the ability for a bank officer or a bank member to borrow from that bank, because prior to that, excessive loans to bank officers and directors became, I don't know, concern to bank regulators. Okay, so yeah, it's a problem when they're using it as their own personal ATM. And the last thing that it did, later known as Regulation Q, is it mandated that interest could not be paid on checking accounts, and it gave the Federal Reserve the authority to establish ceilings on that interest that could be paid. And the view was that the payment of interest to bonds led to excessive competition amongst banks. Do you remember a couple of years ago about banks opening up checking accounts and I don't know, their clients didn't even know about it? Competition in there? Yeah, maybe it's happened once or twice. Causing them to engage in unduly risky investments. SVP, Silicon Valley Bank, didn't have any of those dollars invested a couple years ago, but weren't making enough money and decided to be competitive and raise the interest rate on their checking accounts. So they took all that money and put it into long-term treasuries that went down. There's a risky investment in a world where we had low interest rates that could go up. And ultimately, again, this ban of interest-bearing demand accounts was created what's effectively called the demand deposit account. And there was a reason for that. Demand deposit means that you go to that bank, you can demand your money right there and then. And that is effectively what we knew as checking accounts. What it is it essentially says that the bank had to keep 100% of demand deposit Federal Reserves had to be sitting there in the bank, so that if everybody came and took the right to get their checking money out, they could. Now, savings accounts, different rules. We know we're lending that. We know we're getting interest. So as a customer, you kind of sign your paperwork, says you may not be able to get this money back immediately. It could take you 30 days. Most of the time, it's only going to take a couple, worst case, but they can limit how much you take out. But here's what happened. Dodd-Frank, which was supposed to help with a lot of risk, the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 effectively repealed the prohibition of interest-bearing demand accounts. What also happened? The 1930, the Glass-Steagall Act of 1933 got watered down in 1999 and effectively took away most of the parameters, including the limits in which commercial banks could involve themselves in investment activities. Now, let's do this math, okay? So beginning July 21st, 2011, financial institutions became allowed but not required to offer interest-bearing accounts. Lead us to today. That's what has caused this problem. We had a regulation in place, Kirk. It took it away. But let's go back further to 1999 when they watered down the act. They allowed commercial banks to get involved in investment banking. Tick tock, tick tock. 2005 comes along. By 2004, we were already seeing the risk of leverage in the credit system and mortgage-backed securities, investments, and volatility, a lot of really risky investment taking in the credit markets and packaging these things. And what happened by 2008, Kirk? It broke. So less than 9 years after the watering down of an act that they put in 1933. So I'm trying to do the math here. 85 years of almost no bank failures. And here we are in 2023. And we've had two major, and again, I'm saying major with this one recently because, they stepped in to stop it for a moment where we were on the cusp of massive contagion. So let's just call this two massive bank failure events in 23 years. So 85 years of calmness. It all comes back to 1999. And the unraveling of that started what is effectively something that now, instead of fixing it, because they're not passing regulation or putting that back in place, what they're doing now is they're doing stopgaps. They're basically doing very limited things here to try to get us by. We talked about this, the bank term lending program. Like you said, stepping in and making Silicon Valley Bank the safest place to put your money. Why? It's not because Silicon Valley Bank is no longer leveraged. It's not because Silicon Valley is liquid. It's because the federal government is now, or the Federal Reserve is now going to step in. And in order to meet the demand deposit requirements, they're going to allow those banks who are already leveraged to borrow more money on a short-term basis. And so today, Brian Westbury came out, and he's an economist I follow. I think he's a really, really good follow. If you're not following him, at Westbury, and that's Wesbury on Twitter. He posted today, he said, quantitative easing created bank reserves in exchange for bonds. Banks now have huge amounts of excess reserves, and he's been preaching this for a while. And I've talked about this in past conversations with you, Kirk, that basically the Fed funds rate went from what banks charge each other to basically what the Federal Reserve now pays for those reserves sitting there. And by the way, I forgot to add in, let's go back to 2020 and make it even worse when the Federal Reserve, so PPP came out, right? I'm going to go back. PPP came out. COVID caused all sorts of panic. So they released PPP, which of course we don't know where 80, 90% of that money went. That's a different topic. But PPP goes out, and they say and PPP was money that the Fed was backing, but they were going to the bank saying, you're going to be the direct lender, backed by the Small Business Administration and ultimately all of the covenants of, that were built into it. And you know what the bank said? You're kidding, right? We're looking at the rules going, well, we can't do that. What do you mean you can't do that? Well, we have a reserve requirement that you've told us to maintain, and which did go up after 2008 so that there would prevent insolvency and bank collapse. And then they said, well, we can't do that because if we lend this money out, we'll be in violation. So guess what the Federal Reserve did, Kirk? They lowered the reserve requirement to zilch. Not zero on savings accounts, zero on anything. Checking accounts, nothing. You could effectively have a bank with not a $0 sitting in it. So guess what? Now, should that have been a temporary fix? Maybe. But then they turned around and they never put it back up. So of course, sitting there not making enough money out of a competitive reason, Silicon Valley banks, former Lehman Brothers financial officer, which I believe has been through this once and kind of screwed this up previously with mortgage-backed securities. Although I will say he was not the chief CFO of Lehman Brothers Holdings. He was just, part of their investment bank at a smaller level. But still, you'd think he's been through this once or twice with mortgage-backed securities. Once again, collapsed a bank because of mortgage-backed securities. But again, they literally were able to take every dollar and lend it out and buy those bonds in order to try to pay a little bit of interest to be competitive. Again, got the competition, in the end of the day, competition unchecked in the common good. And again, it's not my own business. I'm now dealing with other people's money, other people's assets, other people's lives at stake. There's got to be some sort of a common good. So I'm going to get back to Brian Westbury and then I'll turn it back to you. But he said the banks then went to having huge amounts of excess reserves, earning overnight rates from the Fed, what I just talked about. Quantitative tapering does not shrink the size of the banking system. It just slowly swaps those bonds back in exchange for the reserves. And this increases the duration of their assets, which increases the losses in a rising rate environment. So while SVP had a micro issue, and we've talked about those politically, what they were involved in, and some people say, they're political, where they left wokist, whatever. Again, I'm not getting into that. Those issues were actually exposed by a macro issue that the Fed could no longer hold these rates artificially low. So again, who's to blame for this whole thing? Well, there is a blame to the customers, because the customers obviously panic. And anytime you get emotion with money, problems are going to happen. Again, if they all panic and run on, It's a Wonderful Life. I love the part of It's a Wonderful Life when George is trying to go on his honeymoon, the bank run happens, and he goes to the first guy, and I forget the guy's name. He goes, how much money do you need? He goes, I'll take $243. He's like, oh, come on, help me out here. I don't have that much money. He's like, I want my $243. So the guy wants all of it. He gives it out. The next lady comes up. He's like, how much do you need? And she's like, can I get by with I forget, $20? And he kisses her on the cheek. He's like, thank you. Thank you for just getting what you need today. We're going to get through this. So yeah, the customers are certainly a little bit to blame here. But the blame goes back to the Federal Reserve for lowering the interest rates. It goes back to the way they're swapping these things out. It goes back to the federal government for lowering the regulations. And it goes back to the banks who, in the absence of any regulations, just can't help themselves because they're employees of this bank and all they care about is making their next bonus. So when those assets durations increased, that increased the losses in a rising rate environment, again, because the Fed also kind of promised these banks they weren't raising interest rates. Do you remember when they said it was transitory, Kirk? Yeah.
Very well.
Yeah, it's transitory. And the banks heard this from the Federal Reserve and thought, okay, you're not raising interest rates. We can make some long-term tactical decisions here. That then the Fed basically reversed within less than a year and said, we changed our minds. Sorry, suckers. So now the Fed has gone back because all of what that did, and we showed this chart previously, it took a bank like Silicon Valley Bank, who was over leveraged, and took what they had as capital, and when adjusted for their losses now on that investment, basically had negative equity. Okay. And they had to sell them at a loss. So the Fed could obviously no longer hold these rates artificially low. So the Fed then had to backstop the bond portfolios, swapping longer dated bonds for the shorter term yields, basically taking away the duration risk, which guess what, Kirk? According to Brian, he's probably right on this. What they just did last weekend with the bank lending, it is quantitative easing all over again. So we've gone from quantitative easing to quantitative tapering to boom, a short-term fast slam quantitative easing. Slowly but surely, the Fed is, in his opinion, of course, not ours necessarily, but nationalizing the banking system, something Alexander Hamilton was trying to do 250 years ago. And everybody thought that was a bad idea at the time, which is why the national bank never happened. And so now they're trying to nationalize the federal banking system in order to hold government borrowing costs low. By the way, if government borrowing costs stay low, is that good for the federal government that has debt interest payments coming? And of course, that's when they're coming back and blaming the private sector. Well, it does it, even though it's a Fed policy and a government policy problem. And again, long term, this is going to just kick the can down the road. And this is where I'll turn it back to you, Kirk, because that's what we've been doing for a long, long time. But really, we've been kicking the can down the road since the collapse of the dot-com crisis. We offset the dot-com crisis with real estate, which then crashed in 2008. Quantitative easing helped to make people feel good about that. And then all of a sudden, we're back. So at some point, the can only get kicked down the road so far before the friction melts everything. What are your thoughts, Kirk?
I agree, and actually, one of the advisors that works with us, Mark, I'll give him credit for this. He sent me a video because I don't think I've ever watched It's a Wonderful Life to the fullest. I may have seen it as a kid, but it's kind of like one of those old movies that they say, "Oh, this is the best movie ever," and you're like, you watch it, like this movie's garbage. Like I can't watch it. So it's I'm not saying that movie is, but it's in that category of like the all-time best, like Gone with the Wind and all that.
It's the second best Christmas movie to Die Hard.
Well, I could definitely agree. As a Christmas movie, it doesn't compete with Die Hard. But
by the way, I do want to say something on that just for humor's sake. So I was watching the Bruce Willis roast, and he came out. He said, and I'm going to say it for once and for all: Die Hard is not a bleeping Christmas movie. It's a Bruce Willis movie.
That's good. That's good. That's awesome. I always liked him. But anyway, so the point Mark was making was that the bank run scene, that the banker is seen as this this altruistic guy, and he's saved Christmas, and really he's the villain, right? Like really the banker's the villain when you look at it from that perspective, because he caused all this. And it's funny because when you think about the banking industry, it's I'm kind of of two minds about it, because on one hand, if you don't have banks, if you don't have the financial system, you don't have progress. And I think this is really part of it. And I want to address both sides. And my libertarian friends are going to hate me for this. And I don't care, because I think you have to be mindful of this. Is that in an ideal world, you can have an ideal world where there's responsible banking and responsible money and all that. That's great in theory. However, in practice, that's not how the world works. You have to find some messy middle in there. The problem is the messy middle becomes toxic, right? And it's like government, right? It's the necessary evil. Well, I don't know. Sometimes I wonder if it is a necessary evil, if they're not making things worse. If we didn't have like a centralized government, would we all? We certainly wouldn't be over in Ukraine and warring with Russia, right? I mean, there would be so many things that wouldn't happen if we didn't have a government to make things better. And for those of you listeners, I'm putting that in air quotes. So the when I think about the banking industry, it is a necessary evil. We do need it to keep a functioning economy and to keep liquidity going, to keep things growing. The problem is if it's not responsible, which, when we went off the gold standard, it was no longer responsible. And there's a whole website that said what the F happened in 1971. And I thought it was a great website, has all these charts. And we may actually talk about it next week because I thought it did a brilliant job of illustrating like all different sectors of the economy, like what happened, when was the inflection point of when things started to take off? 1971. Like that's when it happened. So to me, it was interesting to think about. But for responsible banking, right? The Federal Reserve's job is to make sure somewhat that they can be responsible and to keep them in line. The OCC's job, the State Banking Commission, it's all their job to keep them in line. The problem is if you don't change behavior, you're there. I mean, capitalism rewards success and rewards profit and rewards risk taking. We just talked about it. It rewards that, and it should reward that. If it doesn't, we don't have capitalism. We have communism, and we all know communism doesn't work, and neither does socialism. And I know the listeners who believe that, they haven't been around long enough or they haven't read history because it doesn't work. It's never worked. It has a perfect record of not working. And so if you kind of look at capitalism, yes, it's not perfect, but it's the best. It's the cleanest dirty shirt in the laundry. So we use capitalism because it rewards risk taking. The problem is you have that ingrained in people. Most people have a risk taking nature to them, even if you're the risk manager, even if you're a bad one in this case in Silicon Valley. But even if you're a risk manager, your job is still to understand risk. And risk is there's a balance between risk and reward. If you take no risk, there's no reward. If you take a lot of risk, there's probably a lot of reward, but also a lot of risk. So you have to find a balance that works. And a risk manager's supposed job, the job is not a DEI instructor. The risk manager's job is to actually manage risk of the bank. I know I'm poking fun at this person because, well, it's deserved. But let's kind of bring it back to what's important is that banks should not be in the business of taking risk. Banks should be in the business of mitigating risk for themselves and for the system. The only way you do that is through incentives that make it painful for them to mess up. Because you can claim hedge funds are they're vulture capitalism, and you're claiming all these people they're toxic and they're ruining the stock market. I mean, you hear this stuff every time there's a problem. Oh, it's the hedge funds. It's those rich people, the rich hedge fund owners. It's not them. They're getting incentivized to take risk. Look at Melvin. What was it? Melvin Capital that basically Wall Street Bets took down. I mean, that was brilliant. And the fact is the hedge fund was right. The companies are dogs. And the Wall Street Bets are like, screw you, rich people. We're gonna take you out, and they did. And you know what? I don't shed a tear for Melvin because at the end of the day, they know the business they're in. They're taking risks. They screwed up, and they had to pay for it. And now it's gone.
And Kirk, they're also the requirement to be involved in Melvin would be an accredited investor. So there is the people that are investing in it is not supposed to be safe money. It's people looking to take a risk for a gain. It's not a check. It's not the same as banking by any means.
Right. And the managers of the hedge fund, they take a reputational risk. So if your hedge fund blows up and your investors lose all your money, maybe you don't ever make money ever again because you can't raise another fund. Now, of course, they probably have billions of dollars anyway, so they don't care. But the point is if you're running a fund,
sorry.
Yeah, I mean, I'm not going to name any names, but if you are running a fund, you have a reputational risk. If you're running a bank, you don't really have the reputational risk. You do sort of, but apparently in this case, they'll still hire you back even if you're at Lehman Brothers or somewhere else and you already made mistakes. I mean, you can't make this stuff up. But
like coaching in the NFL, Kirk. Hey, it doesn't matter if you were 0-13 and effectively everybody on the team hated you. You've been in the NFL, you'll probably get another job somewhere.
Yeah, I mean, they'll find a place for you, right? So, I think it's the same thing. People need to understand that banks should not be in the business of taking risks. That is not their job. Investment banks, they can take risk if they want. Trading firms, they can take risk if they want. It's all up to them as long as they don't, submarine the entire financial system, i.e., if you're big enough to fail. Banks should not have that role, which means you need to incentivize the banking industry to not take risks. One way is to mandate certain things which don't allow them to take these risks. But of course, as we know, if you're mandating it, mandates change, as they did with reserve requirements and with Dodd-Frank. And what was it? I forget what it was called, but it was in the Clinton era where they basically lifted the restrictions on housing, so anybody could get a house, and that's where you had ninja loans, and it just got crazy. So anything that's regulated um, is always there's always the possibility that down the line the regulations change because, oh, the economy's great. What could possibly go wrong if we allow these people to take more risk? So some idiot in the government decides that this is a good idea, or they're paid enough by the industry to do it, or whatever it is. Doesn't really matter. But this happens over and over again. So if you regulate it, then it maybe gets unregulated, right? So that could change. I think the way you have to do it is you have to structure it so it allows a certain type of structure, and it's just a part of the mandate. If you're going to be a bank, you have to be a partnership or some derivative thereof, which requires the people in charge of risk, or in charge of the bank, that they're taking personal risk. They can get rewarded for it, but they're also taking personal risks that cannot be hidden, right, through a trust or other means. So there needs to be some way to put these people responsible. You can't do it after the fact because it's too late. You allowed them to take the risk because there was no regulations. You can't come back and say, well, we need our money back. I don't think that's right either, because you can't. Well, let me reframe that. The government changes the rules all the time, but you shouldn't change the rules after the fact. I think that's wrong, because you had rules of the game, you allowed them to play the game, and they played it in the best way they could, and they screwed up, and you can't change the rules after the fact. I've never liked that when the government does that, but you should change the rules for the next time, and you should make it so that these people don't profit from their mistakes, because the sector is too important to make mistakes, and I think that's the big key. Now, we've got 10 minutes, so I'm not going to get into too much, but probably next week we wanted to go into housing, but I mean, this banking thing just keeps going over and over. And now I just want to touch on one more thing and give it back to you, Doug. Europe's having problems now. Credit Suisse, I believe, is having some issues. The European markets have been having some challenges. So how is this all going to play out, Doug? Is this a global problem, or we kind of or things kind of stopped for the moment?
Well, I mean, I think that's my real concern, because the rest of the world doesn't treat things the same way that our system does. One thing I want to tag on to what you just said about, again, going back to even many of the hedge funds. I mean, because I worked with a gentleman, was a client of ours down in Texas, and they owned a company that did basically, it was like a Gordon Gecko, right? They went out and looked for highly leveraged businesses and acquired them, and then basically sold them off for parts to make profit. And they would package this as an investment. And each one, and what would happen is he was required to keep a certain amount of cash available, because every time they would put one of these packages together, he was required by his firm to put a certain stake of his own money into it. And a lot of these hedge funds have those same requirements. And this comes back to, I think, of one of the fundamental problems with our society is the loudest and biggest voices are public companies. Okay? And unfortunately, we have a society and an economy that's not built to support small business, because even though small business is 70% plus of our entire economy, it is a completely disorganized and completely ineffective functioning mass of business. I mean, we've got chambers of commerce and things like that are trying to organize that, but from a voice and lobbying effectiveness, it's terrible, right? So who has the control? Who has the lobbying power? It's the major corporations, of which most are public, although there's a handful of huge private companies like Cargill and SC Johnson Wax that are still privately owned. And so the thing about going back to the risk you were talking about is the majority of these companies out there, they are incentivized to make profit on short-term basis. And these, even up to the CEO, Kirk, these are employees. They have no skin in the game. They don't think like an entrepreneur. They only think like someone who is being tasked with figuring out how to maximize the bonuses and revenue for shareholders, and them, of which themselves being paid on with stock options, is ultimately self gratifying. Okay, and so they're not incentive. They're not incentive. They're not de-incentivized from risk. There's nothing there to tell them to go away and actually manage risk on a day-to-day basis. And even in our industry, as you know, Kirk, sometimes people will say, well, I will only, how can I pay you when you're just for performance? Well, guess what? It's not allowed in our business. And that is because going back to the Investment Advisors Act of the 1943, I think it was, basically, when advisors used to be tasked with that, they would take whatever risk they possibly could. Because let's say they took all the risk this year and basically got an ARC style return, right? And they were able to make 100% return this year. And let's say that risk was incredibly beyond what you needed, and it crashed and lost 100% the following year. Well, I made my money because I took whatever risk I could to get 100% this year, and who cares? If I didn't make money next year, it was in my best interest to take too much risk because I only got paid when we did better. And so they took that away. They said, look, no, you're going to get paid either way, and it's your job to manage it because you want that client relationship. And ultimately, that's the problem with public corporation. Now, going back to your question, the U.S. certainly stepped up. The U.S. Treasury, the Federal Reserve stepped up to backstop this. And I'm trying to read through this. I believe that VCs might have been behind some of this lending too, which of course is also self-propagating, right? Oh, hey, we are most to lose. We'll lend our own money back to help offset these stopgaps. But Europe and the rest of the world don't have the same policies and systems as we do. Okay. European Union, the European Bank, Central Bank, does not look at these things the same way. So if this becomes an issue of concern outside of the U.S. borders, then yes, Kirk, I firmly believe that this could become much more of a macro problem than is currently being viewed. Because a lot of people said, look, problem solved. This is an isolated thing. Yes, it's an issue. But it's not the bigger issue. But if you start to have this affect the national and central banks outside of the United States, all of a sudden, from an international standpoint, if the international economy banking system becomes non-trustworthy, that is going to creep back in the United States. So I think, if anything, I'm less concerned knowing how our reserve certainly reacted to SVB. I'm less concerned with what's going to go on with contagion in the United States than I would be about looking at what could happen in some of these other areas around the rest of the world. Because let's face it, as much as the dollar is the central currency and as much influence as America has in the global monetary system, the world banks mostly outside of the United States. And there's a lot of contagion effect that can happen if the trust goes down in other areas that don't necessarily have the reserves or interest or policy to stop it the way they just did last weekend.
Great. Well, we're gonna bring on our tax tip of the week with Kelly, and then we're gonna wrap it up here. Let's see, Kelly, you there?
Yeah, I am. Can you hear me?
I can hear you. I was worried about you, Kelly. I was afraid you were in the local Irish pub.
No, I'm not.
Patty's Day today. We're all Irish today.
If you don't send me the link, I can't get in. So there it is.
No, it's definitely my fault. It wasn't Kelly in the pub, although you should be. I don't know why he's talking to us.
I should be. Okay, here's my tax tip for the day. I understand I've got like 8 seconds here. All right. So
9.
Here's the tax tip of the day, and it came about. Actually, this is not a conjured up story. I know you like real stories. This is a bona fide real story. And it actually took place in your kind of backyard in near Cambridge. And it was a woman that made close to $400,000 a year. She paid $100,000 in tax. She's living relatively modestly. She's complaining about her home, not a big home, and her mortgage is, a couple $100,000, $250,000, $275,000, dirt cheap for that area. And she makes a ton of money. We went through her tax return. She's paying Massachusetts. She's paying about $25,000 in taxes, and IRS. She's paying $100,000. She's going, what the heck? is there anything I can do? And, she doesn't have any kids and, not much mortgage interest deduction. She does itemize, that kind of stuff. And so we were talking about it. And this is, I don't know if you and I have talked about this before, Kurt, but I have a belief that for certain types of people that are highly compensated W-2 employees, they struggle to come up with tax deductions. They do. It's like, okay, here's my W-2, here's the base. There's not too much they can do. But they have one really cool thing they can do, and that's my tax tip. And it applies to highly compensated W-2 employees. And it's this. It's find that passion of yours. Find that thing that you wish you could do if you didn't have to do what you need to do to pay your bills, right? It could be, I know you're an athlete, Kirk. It could be running and you got a hockey thing in your backyard. So maybe one of the things you'd like to do is, God, would I like to teach hockey, right? I'd love to be able to do that. For me, scuba diving was it, right? I loved scuba dive. So you find that passion. And for this client yesterday, we uncovered that her passion is art. She's in the medical field. She's a scientist, but she loves art and she loves canvas painting. And I said, bingo, there's your deal. There's your passion. What you need to do is figure out a way to, it's called, there's a concept in criminal law. It's called mens rea, where to get at the motive of a person, you look at what's inside their brain. The IRS wants you to have this mens rea that your goal is to make money, not just to do a hobby, not just to, write off your expenses, but it's what's in your brain is you would like to be able to make money. The only person that knows that is you. Now, there are things that you could do on your own that indicate that. For instance, with her, I said, well, if you really do want to try to write off these business expenses, you probably can't do it last year because that wasn't in your brain at the time last year. But now, get it in your brain. You are now in the art business. Now start doing some things to try to sell it. Doesn't make any difference if you did or not sell. It's, are you intending to sell it and make a profit? Hobby loss is limited to, if your goal isn't to make a profit, then you're limited by this hobby loss rule stuff. But W-2, highly compensated, find that thing that you like, that you'd love to do. It could be travel. It could be dining. It could be hockey. It could be scuba diving. It could be Doug lives up in Minnesota, frozen lake. It could be runs a ice fishing camp, right? That kind of thing. Find what you want to do and put it in your brain to make money at it, and then you can start experiencing some reasonable tax write-off. That's my tip.
Well, Kelly, always appreciate your tax tips. Given the St. Patty's Day, if you could give us one that involves drinking beer, that'd be appreciated. But otherwise, always appreciate your wisdom. We've got another month, I think, almost a month and a day until tax returns are due. So we will be having you back each week to bring us new tax tips. But
Okay.
always a pleasure, Kelly. Thank you again.
Okay, Aaron Gobrawlis. Bye.
All right, Doug, you want to wrap us up here? Take us home. Where can people find more about you?
Yeah, thanks, Kirk. Best place to find out some more information, kind of where we're talking about today, is obviously as a business owner. I'm going to talk about two things today. Actually, I'm founder of two different companies. You can check out automaticbusinessmethod.com, automaticbusinessmethod.com. Now, the Automatic Business Method is for business owners out there. Obviously, business owners are dealing with cash flow issues every day. They're dealing with work-life balance every day. And of course, what's going on in the economy is certainly going to trickle down to a direct impact on how they run their business. And a lot of business owners, again, are trying to figure out ways in which this business can work more effectively without them. so that you're not stressing about the impact and preparing for that uncertainty that can happen in the economy. Listen, if you would like to beat back fear and doubt and create new revenue in a tough economy, then you need the Ultimate 2023 Business Growth Guide. It is a free guide, so go out to automaticbusinessmethod.com and download that free guide right now. This cheat sheet could help you to not only survive, but thrive no matter what happens in the economy, and ultimately create a business that is able to function without you, so you can spend more time in the life that you love, with doing the things you love, with the people you love. Now, on top of that, we obviously are talking about the impact of cash and the impact of the economy and the impact of inflation that we've talked about. And now we're starting to get back into the time when things are going to pick up again for families with college, and trying to figure out how you get someone who is a child of yours that is a high school, preferably a junior or earlier, and get them prepared for college, to pick the right college that isn't going to break the bank, but also a place that they're going to end up with high confidence that they're going to go in and graduate on time. And that means 4 years, and walk off stage on Friday into an extraordinary career on Monday. We have a plan for that too. We have a business, another one of our businesses, procollegeplanners.com. Go out and check out our website and download our critical 2022-2023 college planning checklist. Again, this is free as well. So if you're not going to do anything else right now, whether you do it yourself or you want some help in either of these areas, you still can't afford not to go get free information. So go to automaticbusinessmethod.com, download the Thrive Guide, the checklist, and also go to procollegeplanners.com if you have a child in high school, and download our college planning checklist as well.
Great. Well, Doug, always appreciate you on the show here. And as we're going to wrap it up here, that's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast on the podcast app of your choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to our show notes, resources, and archive shows. Also, we're now on YouTube, so please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a share rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin, so please send him an email and express your feelings. If you're seeking financial advice, talk to an oracle, a fortune teller, or maybe a financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.